Okay, dear students, it is time to begin Chapter 3. Everybody's favorite subject to hate, and that is taxes. Taxes in your financial plan. So let's start with some quotes from very famous dead people. In this world, nothing is certain but death and taxes. You know, that's an old quote that I'm not sure if good old Ben Franklin, statesman, inventor, author, we're not sure if he actually came up with it, because many of the quotes that are attributed to him, he just had assembled into his publication called Poor Richard's Almanac. But still, it's a very, very appropriate quote, because it's absolutely correct, isn't it? Yeah, good old Ben. No more than anyone else, probably. I know people tend to point to George Washington and Thomas Jefferson, but Benjamin Franklin was more, in my humble opinion, as not a an accomplished historian, is that he was responsible for the United States of America becoming a country independent of the United Kingdom. Because why? Yes, good old Ben got the other superpower of the time, France, in on the side of the colonists. The next quote is from Oliver Wendell Holmes, Jr., a Civil War veteran and one of the longest-serving Supreme Court judges. Taxes are the price we pay for a civilized society. Yeah. Is he right? Well, indeed. People will rail against taxes and scream and holler with, kind of good reason, because who likes to pay taxes? But without taxes, would we have any roads or sewer systems or water or police departments or schools? And we do like schools, don't we? Yes, we do. Or aircraft carriers. How much does it cost to just keep that thing floating at the dock, let alone taking it out for a joyride in the Persian Gulf? And I'm sure every single sailor on that ship would bristle at my suggestion that it's a joyride. No, it's expensive to keep a civilization going. And our third quote is from Leona Helmsley. Only the little people pay taxes. And who was she? A hotel owner, a fashion designer, and a convicted tax felon. Right. Somewhere along the line of your personal financial experiences, dear students, you're going to see somebody jumping up and down in the parking lot of a Walmart or something online saying that taxes are voluntary, taxes are unconstitutional, you don't have to pay your taxes. Little civics lesson here, dear students. We have three major government entities in the United Snakes of Armenia. And those are the legislature, which makes the rules as our elected representatives, the executive branch that carries out, executes the laws, and the judiciary, which interprets the laws. And there's a fourth estate, as it's often called, the press, but it's been depressing lately. But anyway, we'll leave that to another discussion. Who makes the laws? The legislature. Who executes the laws? The executive branch. But who interprets the laws? The judiciary, the judges. And the judges and the judiciary have repeatedly naysayed the idea that taxes are voluntary. So don't listen to those crackpots, folks. My understanding is they let you do your time on the weekends if you've done tax evasion, but because they want their money and they want you to work during the week and pay them back. Slide number 2. Taxes and financial planning. About 1/3 of each dollar you earn goes to pay taxes. Well, it's not true. It depends on how much money you make. As you make more, you pay more. But in general, once you've joined the benevolent machine, you're paying about 1/3 of your money to the government. And so a cute little cultural phenomenon is called Freedom Day, Tax Freedom Day, May Day. The first third of the year, January, February, March, April, you're working for the government. And then from May to December, you get to work for yourself. Isn't that a cheerful thought? It's usually far less than that for most people, but still, it's the idea to think that you have partners, folks. You have Uncle Sam and Uncle Cal, and they've got their hands in your pockets, and that's how we live in a civilized society. Understanding the tax rules and regulations can help you reduce your tax liability. And that's what we're going to do in this chapter. We're going to look at the major forms of taxes and how we can reduce our taxes legitimately, smartly. And to help you cope with the many types of taxes, you should know the tax laws as they affect you to the extent that we can, because the tax code is just incredibly complex. Make purchase and investment decisions that reduce your tax liability. Ooh, be careful. Not all tax advantage investments are good deals, in my humble opinion, especially for those of us in the middle class, the little guy, the little gal. And, of course, maintain complete tax records. Slide number 3. There are 4 types of taxes. Taxes on purchases, sales tax, excise tax, sometimes other hazardous waste fees and the like. And you're familiar with this, right? Because every time you go into a store, unless you're buying food or some other non-taxable item, you're paying a sales tax. Taxes on property, property tax on real estate. Those of you who own homes know this, whether you pay it twice a year personally or it comes right out of your mortgage payment. You know you're paying taxes to the county, actually, but it's a little bit more complicated than that, but you pay them to the county of San Diego. And you got to know they have a wonderful sense of humor. They have the 2 payments due in December, Christmas time, and April tax time, income tax time. Just the county, it's not lost on the county. They've acknowledged that it's not the best time, but that's why most people pay it through their mortgages every month. And then there are certain items that have a personal property tax. For the vast majority of us, these are included in our registration for our motor vehicles through the Department of Motor Vehicles. So when you pay your registration, part of that is what California calls the vehicle license fee. And that turns out to be tax deductible, as we'll see when we get to our Form 1040 tax return. Taxes on wealth. Well, now, we don't have that now in the modern world until you die. And even then, the vast majority, far less than 1% of the individuals will ever pay taxes on their wealth. But that's the way it used to be, folks. 2,000 years ago, when the government and the church were basically one and the same, you paid a wealth tax, a tithing. Yeah, it's still in the language, but it doesn't mean the same thing. Tithing meant 1/10. You paid 1/10 of your wealth to the government. And the tax collectors were some of the most hated individuals around. I mean, you think the IRS has bad press now, has a bad bad reputation now. The tax collectors then were just the most hated individuals around, because if you didn't come up with the money, they tied you to a tree and whipped you. And that's why Jesus of Nazareth was got in so much trouble, because he was kind to the 2 most hated people back in biblical times, tax collectors and women, and they tied him to a tree. And so be careful who you consort with these days. But no, we don't have taxes on wealth until you pass away, and then even then, the vast majority of people, 99.87% or something like that, it's a very small number, will ever be affected. We'll discuss this way at the end of the semester when we get to Chapter 14, Retirement and Estate Planning. And then the 4th type of tax, earnings. Yeah, this is the big one, and this is the one we're going to spend most of our time, because this is where most of our tax goes through our income tax, through our payroll. But there is a fifth type of tax on slide 4. It's not really technically a tax. As we read at the bottom, Social Security, Medicare contributions are not technically taxes. They're contributions to a mandatory retirement system and healthcare system for the most workers. Some workers are exempt. But for personal financial planning, it makes sense for us to think of them as taxes. And you'll notice that they're often called payroll taxes, even though they're not really a tax. So what are we talking about here? Well, you know, if you've earned money, that 6.2% of your gross salary goes to Social Security and 1.45% Medicare. Now, it phases out as your salary gets quite large, but still, you're always going to pay Medicare taxes. Social Security phases out. I forget the number for the current year, but it's over $100 and some thousand. If you're self-employed, you pay almost twice this amount, huh? Well, I know you don't like your boss, and probably with good reason, but for whatever money that you contribute to Social Security and Medicare, your boss, your company, has to contribute the same amount. And if you're self-employed, you're your own boss, so you have to contribute that amount. Now, it's not twice as much because it's a tax-deductible expense, but it's close, right? Depending on, again, how much money you make. So there, you have the types of taxes. We are going to concentrate, as we said, on the income tax, but it's important to understand these. Why? Because we need to know where our money's going. What is the effect of taxes, or how much does it really cost? There's a worksheet that we would, after going through these two slides, we would sit down in the face-to-face class and do, and now you're going to do that after, right? Don't blow it off. Okay, good. Say you walk into Best Buy, and you buy a stereo for $299, whatever it is. I don't know. Can you get a decent stereo for $299? Actually, these days, yes. I mean, electronics has the price of electronics has fallen to the point where you can get a pretty darn good. Now you can spend a whole lot more. Yeah, but let's say you bought one for $299, and you walk up to the teller and you give them $299, and they let you know they don't. You have to pay the sales tax, which, depending on what part of the state you're in, is about 8%, maybe a little bit more or less, depending on your particular jurisdiction. So that's $23.92. So you wind up leaving the store with your stereo with $322.92 poorer. Well, not really. Well, it depends. It depends. Did somebody give you that money? Well, if so, that's the cost. That was the cost. But if you had to earn that money, then as we said, you have two partners in on the deal, Uncle Sam and Uncle Cal. And depending on which marginal tax bracket, and we're going to discuss marginal tax bracket in detail, and you're going to want to forget about it, but you can't because we're going to use it for the rest of the semester. The next dollar is taxed at the marginal tax rate. Depending on your tax rate, let's say you're in the 25% tax bracket. Well, the tax brackets are changing. We'll discuss that in the next presentation. But let's say you're in the 25% tax bracket. That means that you would have had to have earned an additional $133.77. Plus, if you're in the 7% income tax for state, and there isn't a 7%, I chose 7 because there's also 4, 6, and 8, which straddles the 25%, so it's a little bit more trickier than that. But let's say you're in the 7% income tax bracket for the state of California. That means you had to earn an additional $37.46. Huh? What are you talking about, Payano? Well, if you get a paycheck, you know what I'm talking about, because you see the money come out of your paycheck before you even get the money. Those are your payroll taxes, your tax withholding. So you had to pay an additional $171.23 Exactly, in taxes to pay that $299 plus the $23.92 in sales tax. And we forgot that you're also having to put money into Social Security. So after Social Security, that $299 stereo cost you $535.08. And you think I'm kidding, but I'm not. Here is the formula on slide 6. And I want you to do the worksheet. There are 2 sample problems, and then I want you to do a few of your own, things that you purchase every day, big purchases, because they're going to be on the exam. But more importantly, it's important to understand this. We take the out-of-pocket expense and divide it by 1 minus the marginal tax rate. Now, again, the marginal tax rate depends upon you. How much money do you make? And we're going to see those rates in the next presentation. But once you've reached the middle class and are trading your life for your paycheck for the mortgage and the orthodontia and the car payments and the internet access and the other things, most people are at 25%. Some less, some more, but those are all going to change. So we took the $322.92 and we divided it by 1 minus the 25% federal tax, 7% state tax, and the 7.65% Social Security Medicare. And we wound up paying $535. And you thought I was exaggerating. Now, in the worksheet, I say, look, forget the 7.65%. Just use 8%. Just makes the calculation easier. You could use either one you want. It's up to you. Use either one you want. But, 8% makes the calculation easier. What can we do about this? Well, there are a few things you can do. I guess you could work under the table. You and your boss can make a deal so that you don't have to pay those. Your boss will love it. And he or she will probably be the one that goes to jail. They usually don't put the employee in jail. But you could go to your own deserted island and learn to raise goats and protect yourself and build your own shelter and decide which parts of the plant are not poisonous. You see, taxes are the price we pay to live in a civilized society. And I know nobody likes to pay taxes, but hey, how much do you think this class would cost if the state of California weren't? Yeah, me don't come cheap. Now, make sure you do the worksheet. Make sure you do the worksheet because they're going to be on the exam. But more importantly, you're going to understand the effect of taxes upon your purchases, which may hopefully change maybe someday your spendthrift habits, huh? Wait till we get to chapter 6 and 5. Slide number 7. Let's prepare. We're not there yet. We will in the next presentation. But let's prepare for filing our federal income taxes. First of all, do you have to file? If you've earned any kind of income, especially if you've had any money taken out of your paycheck, you should file. If only to get the refund or to claim the earned income credit. I mean, if you had money taken out of your paycheck, and even if you don't have to file, you're not required. If you don't file, is the IRS going to call you up and say, hey, Fred, I see you didn't file your taxes, but we got $100 here for you, but we'll send it to you, okay? No, they don't do that, right? So if you've made $10,400 and you're single, and $20,800 for 2017, and of course that changes every year, then you need to file. Okay, and those two numbers, we'll come back to those two numbers later on because there is a special reason for those two numbers. There are 5 filing status categories, but the first two are the most important and most popular. You're either single, legally separated, or married filing jointly. If you're married filing separately, that usually means that you're not speaking to the jerk. There are knives and court orders involved. But normally you never want to file separately as long as you're still on speaking terms. Filing jointly will almost always be a better deal for the vast majority of people. Now, head of household is an interesting situation. That means you have at least one dependent. And this is where it can get a little tricky. You know, maybe the couple is not on the best of speaking terms and they have a child or children, and each of them claims head of household. Well, the IRS, folks, they don't move quickly. It's not like going into a 7-Eleven, but eventually you're going to get a letter, friendly little letter, official business only, saying that you two goofed. You can't both be the head of household. You can't both claim the individual as your dependent, and you're going to have to deal with that. And then if you have lost a spouse, I think it's only 2 years, though, they let you do this. You get to file as if you were still married, which is normally a better deal for the vast majority of people. Okay, so even if you don't need to file, you haven't made this much money, do it anyway, especially because you can do it for free at Southwestern Community College through the Volunteer Income Tax Assistance Program. And we'll discuss this in detail later on. In fact, there's a Canvas module that discusses it, and it's a pretty sweet program that we have here, thanks to our accounting professors who are absolutely awesome. I actually volunteered for it a couple years ago, but I don't have time now. Slide number 8. Which tax form should you use? Well, for many people, especially if you don't have any deductions, no children, you don't make a lot of money, then the easy form, 1040EZ, is the one to use. They used to have this program where you could use your telephone. It was pretty sharp. I helped somebody do it, but that was several years ago. Now I guess they figure the IRS figures everyone's going to use the infernal net and their smartphone to file. We'll discuss the 1040EZ after we've gone through the 1040, because it's such a great relief after you've slogged through the 1040 a few times, which you're going to do. Then you look at the 1040EZ and you go, this is so much easier. And of course it's right. Now the other two are the 1040A and the 1040. My advice, folks, is never use the 1040A. It's not that much easier. It's supposed to be easier than the 1040, but it turns out it's very similar. And if you use the 1040, you will, assuming you use it correctly, you will always be guaranteed to pay the fewest number of dollars of taxes, right? If you use the 1040A, there might be something you're missing because it's not on the 1040A, but it is on the 1040. So my advice is to use the 1040. Now, if you use a software program such as TurboTax or TaxSlayer or Tax Act or one of those, and it spits out the 1040A, the program has already decided that you're not going to benefit from using the 1040. So that's why it spit out the 1040A. So don't get upset if they do that. They've already decided, he or she doesn't need the 1040. But if you look at the difference between the two, they're very similar, and it's not that much easier, the 1040A, in my humble opinion. Slide number 10. Which tax records should you keep? Well, I keep everything, folks. I keep them, and I don't know why, but there they are. Tax forms, instruction booklets, the previous tax returns, the W-2s, the 1099s, the 1098s, any receipts and documentation, any expense documents. How long should you keep them? Well, if you ask people, they'll say, 3 years, 7 years, 10 years, Yeah, this is what the IRS says. The IRS says you should keep your tax records 3 years from the date the return was due or filed, which means 3 years after the year that you did them, or 2 years from the date the tax was paid, whichever is longer. In other words, if you didn't get around to filing in the year you were supposed to file, and then 2-3 years later you filed, you should keep them 2 years longer. Okay. They also then go on to say that you should keep some records longer, but they don't say which records, and they don't say how long. Thanks a lot, guys and gals. I says keep them forever. Now, forever's a long time. We have, and I'm pretty old, we have tax records going back many years, and they're all in boxes stored away. And every year, actually I gave up last year, I look at them and think, I got a scanner. I can scan all that stuff in and then shred it and electronically store it, and then I go lay down and take a nap. So I don't know what's going to happen. I guess when we're long gone, then our son will shred them and everything will be good with the world. So I keep them forever. You decide. Now, the Republican tax cuts of 2017 are, shall we say, controversial at best. And we're going to do our best to discuss what needs to be done for 2017 taxes, because the tax cuts of 17 in December 17 don't take effect, or didn't have taken effect, but only in 2018. So next year everything is going to change. But this year, while we're doing our taxes, we're still doing them in the old way. So we're going to do our best to highlight some of the major changes as we slog through the 1040 form without getting into too much details, because there's quite a bit of details, and there are plenty of articles online that you can read. I put a few on the website. Some of the changes are very politically divisive and hurt states that are primarily Democratic. So suffice to say that this ain't over yet. It's going to be something that will come up in the election of 2018 and continue. Because, and I know, again, this is politically divisive, the tax cuts go overwhelmingly to the rich. There are various estimates that range from 62% to 83% of the cuts go primarily to the top 1%. And I know that gets the Fox News people really upset when people point that out, and they say, well, those liberal professors, how dare they point out the truth? And they say that liberal professors hate the Republicans, and they're biased. But our job is to tell you the truth, folks, and that's, it's hard to argue with facts unless you're Fox News, in which case you can call them fake news and you don't have to worry about the truth. So I apologize for being one of those liberal professors, those elites who want to find the truth of the matter. And it's worse than this. It's actually worse than this because the tax cuts go primarily to corporations, and corporations are already awash in cash. So what are they doing with that money? Well, they're very smart. They're not stupid. AT&T, for example, has given every one of their employees a $1,000 bonus because of the tax cut. Well, that turns out to be about 10% of all the money they're going to save from the cut taxes. They're going to save about $2.5 billion in taxes. They've paid out about $200 million one-time bonus to their employees. Where's the rest going to go? Well, if history is any guide, again, it's bad to tell the truth, but if history is any guide, they're going to buy back their shares, they're going to pay bigger dividends, and who do those primarily go to? The rich. The rich get richer, and remember, folks, I'm a stockbroker. I'm heavily invested in the stock market. I'm one of the people who is going to benefit from this. But I got to tell you the truth, okay? I just want to tell you the truth. And it's going to increase the federal deficit. Now, it depends on who you believe. The more gung-ho, rah-rah people believe that it's going to be about a $500 billion cut. Why? Because they believe it's going to spur economic growth to the point where there'll be more taxes coming in to replace the taxes that were lost. But that's what they said in the 1980s, and that's what they said in the early 2000s, and it didn't happen those two times, so maybe it'll happen this time, we'll see. To over $1.7 trillion if we have modest 0.4% actual GDP growth from this, which is more likely because that's what's happened in the past. But we'll see. We'll see. Maybe this elite liberal professor who happens to be a stockbroker, heavily invested in the stock market and real estate, is incorrect. The corporate tax cuts, by the way, are permanent, but the individual tax cuts that you were given, we were given, will phase out after 8 years, meaning that by 2027, this is not a tax cut, it's actually a tax increase for approximately, again, it's an estimate, we'll have to see what happens, 53% of people, a majority of people, will actually pay more in taxes. Okay, slings and arrows, throw them my way. I apologize for speaking that which appears to be true. Politics, right? Poly means many, and ticks are blood-sucking insects. Now, we are ready. Dear students, we are ready. If you'll forgive me, those of you who are on the more skunk news, Fox News side of the ledger, we're ready to slog through the Form 1040. So when we come back, you should have in front of you, whether on your screen, but it's better to print it out in my humble opinion, the first tax exercise. So that'll be the Form 1040. And then the Schedule A. You don't really need them. I'm going to show them on the screen, but they're going to be so small that it's going to be very difficult for you to see, especially if you're looking at this on your phone. So please print those out for our next presentation, where we, dear students, are going to cover the typical Form 1040 for a homeowner. I know, it's tedious. I apologize. But after you've done it a few times, this isn't that hard. And the truth is, it isn't. It's tedious. It's something that only an accountant will love. Don't worry. Remember, we're gonna insult everybody by the end of the semester. Wait till we get to stockbrokers. But you can do it. I know you can do it. If you can add, subtract, multiply, divide, and keep your attention for more than 30 seconds on the piece of paper in front of you, you can do it. See you in our next presentation, where we will go through a typical Form 1040 for an average Southern Californian homeowner.